Everything you need to know about products and services that can improve your life. This is Experts on Call on CL 650.
And welcome back to Key Pacific StrataLife on Experts on Call on 650 CIL. I'm Tony Giavento, your host, and in the studio I have Gord Lee from CMW Insurance and Dan O'Hearn from Key Pacific Management, and we're talking about insurance on this show. Gord, we were just talking about all of the kind of exclusions and conditions, the roles and responsibilities of brokers, and we were just touching on some of the, the necessities of what strata corporations need to look at for insurance. And one of the issues we've talked about quite a lot is that strata corporations need to replace their property or insure their property for full replacement value. So a little bit about full replacement value, and Dan, maybe we can talk a bit about the appraisers too, the role appraisers play and how frequently they actually do this. So how do we figure out full replacement value, Gord?
Full replacement value, I think in the strata, it's just you got to reinsure for full replacement value. But industry-wide, in real practice, most people would go get a professional appraisal from recognized appraisal firms and determine what is it going to cost to replace today.
Right. So that's today with today's components under today's building code, depending on the scope of damage and what would be required to rebuild the damages and restore it.
Yes.
Yeah, and people sometimes confuse appraisals with being a market value. That's not what this is about. This is construction costs, right? And those are going to vary. And so you can have a firm come out to do the appraisal on it, and they usually do what's called a custodian agreement, and that lasts about 3 years. So typically it's going to be around $1,000, could be less, could be more. And they do a very thorough examination of the corporation documents and of the site. And then on a second year, they will do an update, especially if you have bylaw coverage there, because the corporation may be have to rebuild into current bylaws, so that's going to be some extra cost too. So they'll do that on the second and the third year, give you a value that goes to the insurance company who makes sure that you're insured accordingly.
So the appraiser's valuations basically have to meet the requirements of the insurer. The insurer has to be satisfied that you've had a frequent enough appraisal, I guess is another way of putting it.
Generally it's asked for on an annual basis.
Right.
On the renewal of the insurance, they're going to say, please provide an updated value of the appraisal. So
what happens when you can't get full replacement value? That's one of the issues, because we have a caller on the line, Dwayne. If we can have Barb join us. Barb's from the Fraser River, and they have a float home community, and they're in a situation where they can't get full replacement value insurance on all of their components. And that's one of the issues that people are dealing with.
Yes.
Yeah. Are you there, Barb?
Yes, I am.
So can you explain a little bit to us about what's happening with your strata and your insurance?
With pleasure. We're a marina, and our docks are concrete, and we're working on putting together a depreciation report, and I'm in charge of insurance. And the depreciation report and the insurance seem to meet up midway, having to do with a survey or an appraisal.
Right.
And what I'm finding working with our insurance company is marine insurance may be slightly different, and they don't normally insure for full replacement value. And it was indicated that with a detailed survey that the underwriter would consider. And my question is actually what happens if the survey is such that the underwriter chooses not to insure for full replacement?
Right. Good question, because we do have a variety of marinas that are both for moorage and for float homes around the province, where people are on bare land stratas that have this obligation with the same situation. Gord, how would you deal with that with respect to the appraisal side?
That's a very tough situation to be in, and it is true. Like what Barb said is that with marinas, what happens is because docks and wharfs, those generally have a bit of wear and tear because the movement of the ocean or the waters. So a lot of times is that they would insure it for what they call actual cash value. So it depreciate it because as time goes on, these things wear out and it needs to be replaced. The survey, all they're wanting to see is the real aspect of where these docks are at based on a marine professional. I would think that what will happen in the process of going through the negotiation of it is you probably would be able to find a replacement value, assuming that the survey comes out, pretty positive, or may not be 100%, but may have some recommendations, which I think if you're able to fulfill, I would think most underwriters it would be palatable for them to consider doing a replacement value. Don't really have an answer for you that if nobody's willing to do it, then I would think the problem is more so on fulfilling the Strata Act side of it, that Strata Act says you need to insure for replacement value. So Tony,
so we stumped you.
Yeah, Tony may be able to answer it better.
It's a diminishing replacement value.
But if you estimate it with the actual cash values, could the Strata Corporation put some funds aside to say, like, we're self-insuring for the replacement, similar to a deductible, Tony? Like if they had a $20,000 deductible, or say, you could make the argument, that it's not full replacement because it's full replacement minus deductible. So you're self-insuring for the first 20. So in same theory, I would think if they said, the docks are getting old, we can't give you full replacement. The survey should be able to say this is what's the life left on it.
Right.
So therefore, you could estimate that really, theoretically think of it as a deductible and say if it's a $100,000 replacement, we need to have $50,000 put aside in the contingency, so that if the docks are damaged, we would have to come up with this
an
money.
Escalating amount.
You're self-insuring.
Yeah, you did come up with the same answer I was going to give, which is basically, Barb, I think there's two issues here. The first issue is, unless you can find a policy that is going to be full replacement value, which I think is going to be difficult because you have a declining asset, you'll have to do, the first thing you'll have to do, get your owners at your annual general meeting to vote on the policy so that they're aware. They're actually consciously aware that the Strata Corporation is insuring, but it's insuring for depreciated value, and that the owners, like a deductible, are going to have to offset those costs. One of the problems we have under the Act is there's no insurance for underinsurance. So if you underinsure for something and there is a loss, you can't insure for that. However, you can compensate for it. And as Gord said, create some values. So, so if your docks and ramps and everything are valued this year at $100,000 on a depreciating value, but the replacement's actually $120,000, you're basically self-insuring for the $20,000 difference in the event there's a claim. So the owners need to decide, are we going to save for that and plan for that through our reserves, or are we just simply going to be aware of it and be prepared to pay for it as it arises? But I think that what's going to end up happening if you're on a depreciating value is that you may have to be indicating to your owners every year what that value is, and make sure they're aware of it through the annual documents of your annual general meeting, and they have some disclosure to that. I'm not even sure that they can buy their own insurance to offset those depreciating values, because it's a condition of the type of building, of the structure that you have.
But Barb, I mean, how much do these depreciate in a year? It can't be dramatic.
Well, it's difficult to say because we haven't had a survey. We know that the docks are a little bit more than 10 years maybe old.
Oh, yes. Yeah.
And one of the big concerns is that being a very small strata, there's only 15 owners.
Oh, yes.
And so to pony up enough money to carry the contingency reserve fund that it could, in fact, make up the difference is going to be difficult.
Yeah, and you might want to look at maybe kind of a 10% declining value until you get some statistic from your insurance company itself. That's kind of a rule of thumb, so it becomes 10% of the remaining balance out of each of the years for the life cycle of the dock. And then it declines. It's not as dramatic as you think it's going to be, but it also spreads out over a 10 to 20 year period.
I mean, this can be a really nasty situation. I mean, as Barb's saying, people will have to put the money aside, but you think about a Strata Corporation that generally is underfunded as far as replacements and repairs and maintenance goes. You have a situation here where in 20 years or that you need to do a total replacement, people say, I don't have that money. Well, it's one thing not to have money to replace carpet. It's another thing not to have money to have access to your own home, right? If those docks don't get replaced and people turn down special levies.
Yeah, and the challenge for your Strata, Barb, because even though you're a bare land, which conventionally has lower costs per unit of long-term planning, because you have a combination of docks, ramps, pylons, you also have dredging on a cycle, which is going to have a significant additional cost for you. So it's not going to be inexpensive for your Strata. I'd say keep working at it and see what the results of your survey are. Your Strata might need a bylaw that I would suggest a lawyer write for you that addresses the fact that you're not meeting full replacement value for insurance. And then that way there no one would be unaware of it, whether they were a buyer, a seller, an owner, tenant occupant, no one would be unaware that that condition exists. And that might be another way of dealing with that.
Your response is particularly interesting, Tony, and I think that in our case that might be an alternative way to address this dilemma that we've got. Remembering that all of this kind of hangs on the survey and what the underwriter does when he reviews the survey.
Right. Yeah, no, that's great. Hey, thanks for your question. That's a great question because you were certainly, we're on the coast here, up and down the coast with the radio show. So you're certainly not alone with respects to the question that you raised in the broadcast area, because there are marinas that are strata titled up and down the coast, and it's a significant issue. So thanks so much for calling in, Barb.
Thank you very much for your time, Tony. Take care.
Thank you.
You bet. Bye-bye.
Any other ideas, Gord?
I think it's still going to be the option A, and I would recommend Barb really work closely with the survey and convey the issue she has, because I think in doing that, the surveyor that specializes in these docks might be able to say, these are things you can do to, one, is stretch out the life, to do the proper maintenance and stretch the life of the docks, and two is there might be things you can do to help to get the replacement, because the underwriter is really going to rely on the surveyor's point of view as their eyes to say, what needs to be done. Can we insure this for replacement? Is it, and so I think the survey is the big key to it.
Well, then I think in this case also the surveyor will probably duplicate for them for a depreciation plan.
Absolutely.
Right? It'll give them basically a sense of what their liabilities and assets are and what their running depreciations are going to be. So,
and since replacement's going less every year, I'm sure they'll enjoy savings on their premiums, right? No?
Well, one would hope so. But it does raise the issue about bylaws. There are times when stratas have to deal with insurance issues through their bylaws. And so this is one of those examples that they may be best to address it through their bylaws. So, and have a strata lawyer who specializes in insurance with stratas look at this bylaw so they can properly articulate what the risks are, but make it perfectly clear that the strata corporation has no option. There are no other options available for them.
You can see this raising its nasty head in 15, 20 years.
I can see it raising its nasty head in 5 years.
So I don't know how old this place is, but yeah.
all the owners has to be aware of it. So they know what they're buying themselves into, right? And what their responsibilities are, instead of saying that it's not my responsibility or I didn't know. That's what we don't want to hear, people.
And any parties who have an interest in this as well. So it could be mortgage providers as well who may have an interest in what this outcome is, because it can impact the valuations with respects to assessment. So kind of an interesting question. I'm Tony Giaventu, host of the show. If you have any questions and you would like to get some answers back, email them to questions@strata.life. And we'll be right back after these messages.
This is Experts on Call on CIL 650.